Okay, so hi guys, we just got back from Thailand after being away for 7.5 months. It's good to be back, although it's really cold in Canada. We flew from Bangkok to Cairo, and then from Cairo back to Toronto. We were in the air a little over 20 hours, and I took 16 of those hours to write a book. I just did a marathon book writing session, and that book is going to be available to people on our next video, so I hope you are anticipating that as much as I'm anticipating releasing it. I don't think people need to read big thick tomes on this stuff. This is just basically a synopsis that I think would be helpful for anybody who's getting into investing. And I look forward to talking to you guys again real soon. And I hope you enjoy this video. So here's the gist of the talk today. When someone in the investment world talks about a product or a service being new or innovative, run. Don't walk, run in the other direction, because when these people try to innovate, things go badly. One example of terrible innovation that I came across recently are these so-called Coco bonds, or that's their nickname, that have just received regulatory approval in the United States and have had regulatory approval in Europe for a little while now. They've been selling well in Europe, not so much yet in the United States. When I saw these things and when I heard about them, I thought, have we not learned anything from the financial crisis of 2008 yet? Because what's happening with them now echoes so much with what happened back then. And it seems to me like we, specifically bankers, haven't learned anything yet. And if you don't understand what a Coco bond is or what it does, let's liken this to a family. It's a family of 5, and you've got mom, dad, and 3 kids. The eldest kid is the big, dumb, drunken kid who still lives at home because he can't make it in the real world. And let's call him Blotto. He's like a banker. Every 6 months or so, he crashes the family car. Blotto comes to mom and dad and says, you know what, mom and dad, if you let me sell idiot insurance to my other brother and my sister, it won't cost you as much money next time I wrap the car around the tree. Obviously this is an insane idea, but that's exactly, in my opinion, what Coco bonds are about. Bankers are saying to regulators, and regulators are accepting this logic, let us sell Coco bonds to the world, and when that happens, we won't have to tax the world because of our future incompetence. A ridiculous perspective, and I rarely get that agitated or angry about something, but this really bothered me, because it seems to me like we haven't learned anything from the 2008 experience. Bankers certainly haven't been properly chastened, and they certainly haven't learned their lessons either. Okay, so how do Coco bonds work? Coco stands for contingent convertible, and what that is a fancy way of saying that banks issue bonds with a slightly higher rate of interest, and if things go south for the banks have the right to convert those bonds into shares in the bank. In return for a higher rate of interest that they pay to those bondholders, the banks have a right, and that right is to call the bonds back and convert them into shares in case things go south for the bank, or in case things go badly for the bank. So the contingency is, if things go south for the bank gets to convert these things from bonds into shares. The people who had bonds that were earning them a slightly higher rate of interest, they just become regular shareholders at that point. So that's really in a nutshell how they work. The reason regulators like Coco bonds so much is the purpose of the Coco bonds as sold to the regulators by the banks is we won't hit the taxpayers up for as much money in the future if you allow us to sell these bonds, and by selling these bonds with a higher rate of interest that'll get turned into shares if things go south for us, that'll beef up our balance sheet, which means we won't have to go hat in hand to the taxpayers next time we screw up. The problem is that banks don't know, and they have a history of not knowing, whether we're talking about the S&L crisis, third world banking crisis, or any of the multiple crises that banks have gotten themselves into in the last 50 years. They have no idea what kind of capital they require when things go south for them. So the idea that these things are going to prevent taxpayers from being on the hook the next time banks screw up is a very naive idea. Another problem with this, of course, is that the bank shareholders get diluted even further if the bonds get converted into shares. Let's say you have 1 million shares outstanding and 1 million shares equivalent of bonds. If things go south for the bank, the bonds get converted into shares, and now there's 2 million shares outstanding. There's twice as many people that have access to the same amount of economic pie in the bank. So the people who were shareholders of the bank, they really get torpedoed by the Coco bonds. That's another problem with Coco bonds. Third problem with Coco bonds, of course, is that the Coco bond holders themselves get torpedoed. And this is a classic sign, and this is what we saw in 2008 as well, when institutional investors who should have known better took on a lot of risk, an immense amount of risk for a few extra percentage points of interest. And we're seeing the same thing happen again. What's happening is that the Coco bond holders are willing to take on the risk of being converted into shareholders, in return for an extra % or 2 of interest. That's a very, very naive perspective. That's a silly thing for an investor to do, but that's what they're doing in Europe in droves. In a sense, it makes sense for them to do it in droves because central bankers are driving interest rates so low that everybody is seeking yield no matter what kind of risk they're taking on to do it, which I think is a silly thing to do. And the fourth and biggest problem, in my opinion, with Coco bonds is that they make the banks even more reckless. They give the banks a false sense of security when the bankers get to tell themselves, okay, we've sold X amount of Coco bonds, that cash is now sitting on our balance sheet, we can now go out and be even more crazy and even more reckless than we would normally otherwise be. And given what bankers have demonstrated the last 50 years, they can be really reckless and really crazy with their capital. Coco bonds, when giving them a false sense of security, makes things very, very dangerous and very unstable in the system. And what's really odious from my perspective are the ethical considerations of this. The bankers are saying basically, we know we're going to screw up at some point in the future, and we know that taxpayers are going to be on the hook for that. These bonds are somehow going to buffer taxpayers. We're not going to have to steal as much taxpayer wealth as we did last time. My question is, why is that even on the table? Why are we even tolerating bankers dealing with this? I believe that we should do what Taleb suggested, is when the bankers came hand in hand to taxpayers for money, they should instantly become civil servants. So no more fat bonuses, and you now are an award of the state, which means you are a civil servant. No ifs, ands, or buts about it. Okay, there are 3 main points that I want to leave you with. First, Coco bonds are terrible for society. Societally, we shouldn't tolerate their existence, and I don't know why regulators approve them. They are predicated on the odious idea that taxpayers should somehow be on the hook for the incompetence of bankers in this new form of heads I win, tails you lose, banker-driven capitalism. The second point, Coco bonds are an example of a phenomenon that's happening globally at the moment, and that is investors taking on massive amounts of risk in order to achieve 1 or 2 or 3% more in interest. That's a very, very dangerous game. It happened in 2008 with terrible results for a lot of pension fund managers, for example. It's happening again. We haven't learned the lessons of history, and I think Coco bonds are a great example of how we haven't learned that lesson and why we should. Third, and more generally, financial innovation is something we should try to avoid if at all possible. I really strongly agree with the Galbraith quote. It comes down to fixed income, stocks, sometimes options. All assets are a claim on future cash flows, and when you look at those future cash flows, real estate included, you have to explore the risks associated with them, and people increasingly don't do that, and that's a very, very dangerous game to play.